Hello there! If you're self-employed here in the UK, getting your head around taxes for 2026 can feel a bit daunting, can't it? Well, you're in the right place. The experts at My Tax Accountant have put this guide together to give you a really clear, practical plan. So grab a cuppa and let's get you sorted.
Right, let's start with a number. Over £3,000. For a lot of new sole traders, this is the tax bill that lands on their doormat after their first year, and it's a complete shock. Honestly, it's a figure that can really mess with your cash flow, and it catches so many people out.
And see, that's the thing. For most self-employed people, the tax itself isn't the real problem. It's the cash flow. When you're in a regular job, your tax just disappears before the money even hits your account. But when you work for yourself, it all just builds up silently until this huge bill arrives. So the big question is, how on earth do you avoid that shock?
Well, we've got a plan. We're going to walk through the tax trap itself, then get crystal clear on profit versus turnover. We'll break down what's actually in your tax bill, explain something called the payment on account shock, which is a big one, then give you a super simple savings system, and finally take a quick peek at the digital future.
So, what is this trap? Well, unlike in a job with PAE, when you're your own boss, your tax and national insurance just stack up with every invoice you send. But the real kicker is that the bill for the money you earn this tax year isn't actually due until next year. It's so easy to just forget it's even there, quietly growing in the background.
Okay, before we go any further, we need to talk about the single biggest misunderstanding for new entrepreneurs. It all comes down to knowing the difference between your turnover and your profit. Honestly, if you can get this one thing right, you are already halfway to mastering your finances. Let's start with turnover. This is the big flashy number, right? It's the total amount of money that comes into your business from all your sales and invoices before you take away any of your costs. It's the number that makes you feel like you're flying. But, and this is a big but, you are not taxed on this figure.
This is the number that HMRC really cares about, your profit. Profit is what's left over after you've subtracted all your legitimate business expenses from your turnover. You can think of it as the money you actually get to keep. And crucially, it's the only figure that your tax bill is based on.
So look at it this way. Turnover is the money you bring in. Profit is the money you keep. It's such a simple distinction, but it's absolutely fundamental. Focusing on your profit, not your turnover, is the key to getting your tax right.
So what counts as an expense? Well, these are the costs you have to pay out just to run your business. We're talking about things like your phone bill, software, travel for work, your accountant's fees, that sort of thing. Keeping a really good record of these is your secret weapon for legally reducing your taxable profit, and so your final tax bill.
Now let's break this down. Your tax bill isn't just one thing. It's actually made up of two main parts, income tax and national insurance contributions. Let's have a quick look at each.
First up, income tax. For the 2025/26 tax year, if you're in England, Wales, or Northern Ireland, everyone gets a personal allowance of £12,570. You don't pay any tax on that bit. Any profit you make above that gets taxed in bands. So you pay 20% on the slice of profit in the basic rate, 40% on the next slice, and so on. You're not paying 40% on everything, just the bit that falls into that bracket.
Now, a very important point for anyone watching from Scotland. You'll want to hear this part, because your income tax system is actually a bit different, and it's got its own set of rates and bands. As you can see here, Scotland has more tax bands, with different names like starter and intermediate. The main thing to know is that the higher rates can kick in at different profit levels compared to the rest of the UK. So careful planning if you're based in Scotland is even more important.
Okay, the second part of your bill is national insurance. For the self-employed, the main one you'll pay is Class 4, which is basically another tax calculated as a percentage of your profits. There's also something called Class 2, but these days, as long as your profits are high enough, you're just treated as having paid it, which is good because it protects your state pension rights.
Right, stay with me. This next point affects nearly every single small business, and it is without a doubt the thing that catches the most people out. It's called payments on account, and it can be a massive shock to your cash flow if you're not ready for it.
So what are they? Well, basically, if your tax bill comes to more than $1,000, HMRC just assumes you're going to earn about the same next year, so they ask you to make advanced payments towards next year's tax bill. They're supposed to help you spread the cost, but in your first proper year, it feels like a real sting. Let's look at the timeline to see why. The tax year ends on April 5th. Your deadline to file your tax return and pay what you owe is January 31st the following year.
But look, on that exact same day, your first payment towards the next tax year is also due. Then the second one is due on July 31st.
And here's where the shock happens. Let's say your first ever tax bill is £3,000. When January 1st rolls around, you don't just pay that £3,000. No, you also have to pay the first payment on account for next year, which is half of this year's bill, so another £1,500. All of a sudden, you have to find £4,500. That's 150% of what you thought you owed. And then you still have another £1,500 to pay in July.
Okay, I know that sounds pretty scary, but it really, truly doesn't have to be. With a simple, disciplined system, you can stay completely in control and just remove all that stress. Let's make this simple.
Here it is, the golden rule of thumb. As a safe bet, aim to set aside between 25 and 30% of your profit. And remember, that's your profit, not your turnover. If you do that every time you get paid, you will always have more than enough money tucked away to cover everything: your income tax, your national insurance, and those pesky payments on account.
And my top tip? Open a separate bank account just for your tax. A simple savings account will do. Every single time a client pays you, before you do anything else, move 25% of it straight into that tax pot. Out of sight, out of mind. It just removes that temptation to spend money that isn't really yours to begin with.
To make this feel a bit more real, let's walk through an example. Let's meet Emma. She's a freelance graphic designer based in Manchester, and we're going to look at her numbers for her first year in business.
Emma's had a brilliant first year. Her total turnover, so all the invoices she sent out and been paid for, comes to £45,000. That's the total amount that has landed in her business account.
Now, throughout the year, Emma's kept really good track of her business costs. Things like her design software subscriptions, a new laptop, marketing costs, all that stuff adds up to £5,000.
So, here's the really important calculation. We take her turnover of £45,000 and we subtract her allowable expenses of £5,000. That leaves her with a taxable profit of £40,000. This is the only number that HMRC will use to calculate her tax bill. So now we can work out her bill. Based on that £40,000 profit, her income tax is £5,486, and her Class 4 national insurance is £2,573. This gives her a total tax bill for the year of £8,059. So to cover that without any stress, Emma needs to be saving about £672 every single month into her tax pot.
Okay, now that we've seen how this all works in practice, let's look to the future, because there is a really big change coming that you absolutely need to know about. You'll want to hear this part. It's called Making Tax Digital.
Right, so Making Tax Digital, or MTD, is HMRC's big plan to modernize everything. It's coming in stages. From April 2026, it's mandatory for self-employed people with an income over £50,000. A year later, that drops to those with an income over £30,000, and it'll continue to roll out from there.
So what does this actually mean for you? Well, it's pretty much the end of that mad scramble to do your tax return once a year. Instead, you'll need to use special software to keep digital records and send a summary update to HMRC every 3 months. It's a shift to a more little and often approach to your tax.
Now, this change is designed to make everything more accurate and efficient in the long run, but it does mean you need to be prepared. So it's a good time to ask yourself, are my records and my systems ready for this digital shift? Getting the right habits and software in place now is going to make this transition so much easier.
Now, just a very quick but important disclaimer. This information is for general guidance only. Everyone's business and tax situation is unique, so please don't see this as a substitute for proper professional advice that's tailored to you.
The tax system can feel really complex, but you absolutely do not have to figure it all out on your own. For expert advice that's built around your specific business, we really do recommend you speak to a professional. You can contact the friendly team at My Tax Accountant by phone or email, and for a more detailed read on everything we've talked about today, check out their fantastic blog post. And finally, if you found this helpful, please do subscribe to the My Tax Accountant channel for more clear, practical advice to help your business succeed. Thanks so much for watching.